So for this mock exercise, we're going to take a look at a company called Marietta Corporation. And they've given us 4 scenarios, 4 situations. And these situations are listed here. And we're asked to look at, for each situation, identify the assumption, principle, or constraints that have been violated. So we're looking for violations in our assumptions and principles in MGAB. And we have to explain what should have been done. Okay, so let's look at the first scenario. So in the first part, it says land with a cost of $208,000 was reported at its fair value of $260,000. So in this case, what is being violated here is called the historical cost principle. That's been violated, okay? And historical cost principle states that the amount of cost or cost equivalent given up is the basis of initially recording the financial statement element, which in this case is land. So if I paid $200,000 for this land, but the fair value of this land, so if I paid $208,000 and the fair value of the land is $260,000, then you can't record the land at fair value. You got to record the land at the cost of how much you paid. So that's the key part of historical cost principle, is you record land for the price paid, which in this case is $208,000, not the fair value, which is $260,000. Okay? So this is in violation of what we call the historical cost principle. Scenario B, it says the president of Marietta Design, okay, Dina Dunford, purchased a truck for personal use and charged it to her expense account. So in this case, what is the violation? The violation in this case, it's called the separate entity assumption or the economic entity assumption. Okay? This is in violation of that because under this assumption, transactions of an entity, a business entity, must be separated from transactions of owners. Okay? Now, because the truck is used for personal use, it's not used to generate revenue, then this transaction should not be recorded in the business. And that's why they violated that assumption. Now, if the personal truck is used, it was bought by Dina, and it was used to deliver products to and from customers or picking up supplies, then in this case, it would be a charge to a business because it's being used to help generate revenue. Okay? Third, Marietta wants to make its earnings look better, so it added 2 more weeks to the year, creating a 54-week year. Previous years were 52 weeks. So in that case, what Marietta is doing is recording transaction that does not belong in the fiscal period. So this is in violation of what we called the time period assumption. And time period assumption states that companies period or reporting period should be reported over a series of short period of time, normally yearly, maximum 12-month period. And we use that series of time, we divide that the life of the company into these short periods of time to help us prepare the annual financial statement. And we do this artificially. Obviously, we would some companies would report monthly, quarterly, or yearly. And by adding 2 more weeks to the year, Marietta would be misleading their financial readers to show how much money they actually made this year, and it's not comparable to prior years, to previous year's results. So they are in violation of what we call the time period assumption. Finally, in D, it says the president wants to make sure that the company was not accused of hiding anything from its shareholders, so she instructed the CFO to disclose everything that happened during the year in the notes to the financial statements. The notes ended up to be 95 pages long. So this is, in this case, they're over-reporting everything to its readers. And in fact, 95-page long means that they may be disclosing and reporting activities that may not be of any significance to a reader for decision-making purposes. So this is in violation of what we call the cost-benefit constraint. And the materiality constraint. The cost-benefit constraint states that the value of the information must exceed the cost of providing it. The cost of providing such detailed disclosure is likely greater than the benefit to the users of that financial information. A financial report, such as a financial statement, should include all information that is what we call material. Material means something that a decision maker, decisions of the decision maker may be affected or impacted by having that information available. A financial report should include all information that's only material. Information is not material should be omitted. It is likely that much of that information captured in a 95-page note disclosure, some of them are probably not material, and it actually clutters the financial statement and hides or, muddies what's important, what's not important. And of course, the more important information would be difficult to find by readers having to sift through 95 pages of note disclosure. Thank you.